For most of modern history, borrowing money came with a clear price. Then, after 2008, that price nearly disappeared. Interest rates fell towards zero. Central banks purchased trillions of dollars in financial assets. Investors learned that whenever the economy weakened, more support might arrive. What began as emergency medicine slowly became the environment in which an entire generation made decisions. This was the era of cheap money, and it changed almost everything. The story begins with the financial crisis of 2008. Banks were failing, credit markets were freezing, unemployment was rising, and the Federal Reserve cut its policy rate until it was effectively near zero. But once rates reached the floor, the Fed needed another tool. It began large-scale purchases of Treasury securities and mortgage-backed securities, a policy better known as quantitative easing. QE is often described as printing money, but that phrase can be misleading. The Fed purchased securities and created reserve balances inside the banking system. The goal was to push down longer-term borrowing costs, stabilize markets, and encourage lending and investment. In the emergency, the policy helped prevent financial conditions from becoming even worse. But the emergency lasted longer than almost anyone expected. Low rates made mortgages, corporate loans, and government debt cheaper. Investors searching for returns moved into stocks, real estate, technology companies, and riskier forms of credit. Asset prices rose. Anyone who already owned a home, a retirement account, or a business often became wealthier on paper. People without assets faced a different reality. Homes became harder to afford. Savings accounts paid almost nothing. The economy recovered, but the benefits were uneven. Cheap money also changed corporate behavior. Companies could borrow to expand, purchase competitors, repurchase shares, or finance deals. Private equity firms could acquire businesses using large amounts of debt. Some unprofitable companies survived because new financing remained available. None of these outcomes came from interest rates alone, but cheap credit rewarded leverage and made future growth appear more valuable. The system became difficult to leave. When the Fed tried to reduce support, markets reacted. In 2013, merely discussing slower asset purchases caused bond yields to jump in what became known as the taper tantrum. In 2018, as the Fed raised rates and reduced its balance sheet, financial markets fell sharply. The central bank changed course in 2019. Investors absorbed a powerful lesson. Weakness in markets could influence monetary policy. Then COVID arrived. Economic activity stopped with extraordinary speed. The Fed cut rates back to zero, restarted massive asset purchases, and introduced emergency lending programs. Congress authorized enormous fiscal relief. These were separate policies, but together they placed unprecedented support beneath the economy. The intervention prevented a health crisis from immediately becoming a financial collapse. It also helped produce a strange moment when terrible economic news could coexist with rising markets. By 2021, demand was recovering faster than supply. Factories, ports, and labor markets struggled to adjust. Energy costs rose. Fiscal stimulus supported household spending, while monetary policy remained extremely loose. Inflation did not have one cause, but the combination of strong demand, disrupted supply, and prolonged support helped create the highest U.S. inflation in 4 decades. The Fed responded by raising interest rates rapidly. Cheap money disappeared, and the vulnerabilities it had concealed began to emerge. Bond prices fell, mortgage payments surged, technology valuations dropped. Highly indebted companies faced refinancing costs they had not planned for. In 2023, Silicon Valley Bank failed after rising rates damaged the value of its securities and depositors rushed to withdraw funds. The end of cheap money did not break everything, but it revealed how much of the system had been built for rates that stayed low. So did easy money save the economy or distort it? The honest answer is both. In moments of panic, aggressive central bank action can stop a destructive spiral. But emergency policies create incentives, And the longer they remain, the more people organize their lives around them. Investors take greater risks. Governments find debt easier to carry. Companies assume refinancing will remain cheap. Asset owners benefit first, while renters and younger workers struggle to catch up. The most important lesson is not that quantitative easing was simply good or bad. It is that money has a price, even when the interest rate says otherwise. Cheap credit can move tomorrow's growth into today. It can also move tomorrow's risk into places we do not notice until conditions change. The era of cheap money changed housing, markets, corporate power, and inequality. Its greatest legacy may be the belief that every crisis can be solved by making money cheaper. The next crisis will test whether that belief still survives.